Hello everyone, welcome to Naked Money, the truth about money in simple terms. I'm your host Akil, Ahilan Balachandran, certified financial planner and founder and CEO of LifePlan Investments. Today we have our guest, Prashants.
Yeah.
Welcome, Prashants.
Thanks for having me on the show, Akil. It's an honor to be here. I'm looking forward to chatting with you. I guess I'll start off by giving you guys a brief summary of my background and who I am, essentially.
Yes, please. Yes.
So my name is Prashants Varatharajan. I'm a partner at Galleon CPA LLP. We're an accounting firm specializing in working with small to medium-sized owner-managed businesses, as well as real estate investors and tech startups. Those are kind of our two big niches.
Exactly.
So for me, I got into real estate investing myself personally when I was looking for ways to build wealth and generate passive income. I'd gone through the traditional route, became a CPA, CA, was working at Pirasaanth for a number of years, and I realized, I can continue working the corporate ladder and climbing that and getting to a certain point, but if I really wanted to make money and have a passive income source coming in, I would have to pick up another strategy rather than just the active
Absolutely.
income, right?
Entrepreneurship, right?
Yeah. So what I learned, going and having done my accounting and business degree in university, I learned a lot about money doing that and becoming an accountant, but not about making money. So that's a whole nother learning strategy that you have to go and educate yourself on and pick up these things in order to go ahead and generate wealth, right? So for me, real estate was one of the easiest areas for me, and traditionally one of the avenues that have worked well for people over time to go ahead and generate wealth. So that's when I got into real estate investing and looking at the different strategies on how to build a portfolio and get that passive income.
Absolutely. So that's a great say, because you don't learn everything in the university. Same thing when I become a financial planner, or took the personal finance course at RRSPs University, which I graduated from. But when I really started working in the field, I learned a lot throughout the year, working with my mentors and coaches and people, and learning continuously on there. So that's very important. You learn about money, but you don't know how to make money. So now we're talking about the real naked truth about money. We're going to be talking about real estate investments, and we had talked about borrowing to invest compared to versus people borrowing to spend money.
Right.
We talked about in that and RRSP loans and RRSPs in the beginning of episode, and we talked about some of the mortgage for millennials in the second episode. This is our third episode. It's kind of falls in the right place. Before we jump in, I just want to make a comment to our readers, listeners, or people who's watching it. People rushing into the RRSPs. And we don't really need to be rushing in the last minute of first 60 days contribution.
Agreed,
You need to be really, as an accountant, CPA, CA, you know that. You need to plan ahead of time and understand.
You want to be in a position where you're being proactive with your situation rather than reacting at the last minute.
Exactly. So I think that's one thing, starting from RRSP, moving into going back into your talk today. So let's talk
100%.
about what the people need to be doing before they get into the real estate investments.
So a lot of people tend to just think, okay, real estate is you go ahead, you buy a property, wait for it to increase in value, and that's how you made your return on it. But within real estate investing, there's so many different strategies you can use to make money. So one of the most popular one is investing for appreciation, which is kind of the one I just mentioned. You purchase a property at a certain value, you hold the property over time, the value of the property appreciates, and you've now built that equity, which you could either sell to access that capital gain, or you could go ahead and refinance the property and access that equity to make money. There's another strategy called the cash flow strategy. So this is areas where you invest and the properties aren't necessarily going up in value. The appreciation might not be there, but the rental market is very strong and you're cash flowing. So what I mean by cash flowing is your income coming in from the property versus all the expenses and your mortgage payments, everything going out from the property. You have a net income amount of cash coming into your pocket at the end of the day. Right? So cash flow can be two different things. For example, if you're renting a property and then you have your mortgage payment, you have your property tax, insurance, all of that good stuff, and you're at your break even, technically you're still making a gain because within the mortgage payment there's principal pay down, which is being paid by the tenant going towards the mortgage, right?
Exactly, yeah.
But you're not left with cash at the end of the day. Cash flowing is when you've covered all that stuff and you still have extra cash coming in, which is now passive income for you. Does that make sense?
Yeah, I think I want to make a point here. One of the things when we have our clients want to make real estate investments in that situations, I know the accountants are on the tax part, but we as a financial planners and advisors, we recommend the clients to look at whose name they're going to be getting into investments, because sometimes when they have additional income, that's actually bumping up in the tax bracket, so that they're end up paying more taxes as well, right? So that's need to be planned, I think, with the right persons and right professionals. Right?
So to add on to your question there, so once you go down the real estate investing journey, it's very important to get your 3 key contacts involved to make sure you're setting yourself up for success. And those 3 contacts, I would say, is a financial advisor, a financial planner, your lawyer, and your accountant. And then that way, those 3 people working together in a unit, and with you having conversations with them will allow you to plan best for success. So the accountant can help you plan from a tax perspective as well as a financing perspective if you're going to go ahead and grow a big portfolio with a corporation and things like that. If you're going to go ahead and use your RRSP to get loans or use the home buyer's advantage, you want to make sure your financial planner's in the loop there. The financial planner will know what your overall wealth scenario is and how you're going to be able to qualify, things like that. And then your lawyer needs to be kept in the loop to make sure that they can close the deals and whether you're going to be refinancing another property and then having that bridge into another purchase, etc. So those 3 people need to be working together, and you need to be constantly meeting with them as well.
Yeah, I think just want to quickly touch based on what you mentioned about RRSPs, and then we'll move into the next section. So one is about RRSPs. A lot of people, I think we talked about before we start the podcast, and a lot of people don't know that they can actually borrow money from a certain financial institution, use that borrow money. If they're first home buyers plan, they don't have to pay off the loan to take that money and put it in the down payment for the house.
Right.
They can actually, what they can do is there's some strategies that if they have a proper overall picture, we can actually help them borrow the money, like 70,000. If it's husband and wife or common law partners, they can borrow 35,000 each, and then after 91 days past, they can actually use that money for the first home buyers plan as well. So there's some strategy, but again, a podcast is not for financial advising place. We're just talking about naked truth about money. So you need to talk to the right professionals like a CPA and financial planners and CFPs to really look at the overall picture before you jump in and make some decisions. So
for sure. And that strategy you mentioned, can have a big tax savings impact for you. And, overall financing makes things easier for you as well.
It's really funny, we're talking about naked truth. I think we can talk hours and hours and hours.
Yeah.
I saw people who's just graduated from university, been advised by some people, say, okay, start $25 of RRSPs. Yeah. That's what I really, when we start about this naked money and said we want to bring all the truth and plannings, and again, we cannot help all the millions of Canadians here, but there's a lot of good planners and good advisors out there. They can help you in the right way. But I think the one major part, Prashant, people sometimes they spend money for nothing, and then they don't want to spend money for the right reasons. I mean, talking to the right CPAs and talking to the accountant and talking to the qualified financial planners are extremely important. Spending that money will save. So, for example, when you're talking about investing as a real estate investment, in the tax as a CPA, and you can see there's some people using the personal and versus some of them corporate, right?
Right.
So what's your take on where you see the mistakes happen and how you see that? Yeah.
You know what's one funny thing I see all the time, Akil, with real estate investing is a lot of people will go ahead and they're buying 1 or 2 properties and they'll automatically think, okay, I need to put this in a corporation. They don't consult an accountant or a financial planner, and they think, oh, the corporation must be the way to go, or some of them will hold it personally. You need to really sit down with an accountant or financial planner and and decide based on your situation what works best for you. So, for example, the age-old debate: do I hold the property personally, or do I hold it in a corporation? So let me tell you what happens if you buy one property and you put it in a corporation, right? That one property, all the rental income that you earn on that property is going to be considered passive investment income, right? And that's going to be taxed at the passive investment income tax rate, which is 48%. So let's say, for example, we'll use some big numbers here for simplicity. If you're making $100,000 in rental income out of, one apartment building or one property that you made, right? We're using hypothetical figures here. You're going to be paying $48,000 in taxes on that income because you had it in a corporation, right? Whereas if you held that property personally, right, depending, again, this is where the accountant and the financial advisor would help you, depending on how much income you have from employment and other sources, you would have to make an analysis to see if it would make sense to hold it personally or put it in a corporation. Now, with the corporation, here's a good value nugget for the viewers here. If you have the one corporation, it's 48%, right? How you get around this is you set up something called a 3-tier corporate structure. So using the 3-tier corporate structure, you set up another corporation that's called the property management company, right? And then that company is going to be responsible for all the active day-to-day activities involved with making this a successfully operating rental property, right? Going, checking up on tenants, coordinating with contractors, managing renovations, etc., right? And so for all that work that is being done, this corporation, so this one, the first one made $100,000 in net income. The property management corporation can invoice the real estate corporation for $100,000 and move that money over here. So now this guy is going to still be at 48% tax bracket, but he's paying 48% on $0, which is zero. Now this one, which is an active corporation, is now going to be paying 12.5% on the $100,000, right?
Their property management,
they're active. So then now what happens is, okay, then you're going to be like, Prashant, okay, I've now moved this company here, but this is my real estate company. I want to be buying more properties with this, $100,000 I have before taxes. So then what you do is you set up a holding company at the top, and that's called a 3-tier structure. The holding company will own both of the other companies. So this guy will intercompany dividend it over to the holdco, which can be tax-free because the corporations are related. And then this guy will intercompany dividend it back into the real estate co. So now the after-tax money is back in the real estate company, and you can continue to buy more properties. So that's overall the structure you need in place to successfully be buying rental properties through a corporation. But the structure, if you're buying 1 or 2 properties, you don't want to be spending $2,000 on each corporation, $2,500 for each tax return. The compliance costs alone are significant, right? So that's why it really depends on your situation, right? Like there could be a situation where you're already in the top tax bracket personally, making above $300,000, and in that case, if you owned all this money, if you owned all these properties personally, you're getting taxed at 50%, right? So in that case, it may be more effective overall if we did the numbers and did the analysis that even with the compliance costs and all the tax you save based on how much income the property's bringing in, and you're planning on buying more properties and the income's only going to continue increasing, it makes sense to do the 3-tier structure, right? So that's why it's important to talk to your accountant or your financial planner before you go ahead and purchase it in a corporation or decide to hold the properties personally in your own name.
Absolutely. I think the real idea is really, yes, there's a strategies to minimize or mitigate the taxes or the savings for your hard-earned money. But then you had to really look at what's your situation right now, in personally, whatever your income making, what's your plan right now, and what's the future is holding you. Are you going to buy more properties? Are you going to buy different things? Are you going to go south of the border, right?
Exactly.
It is all part. So let's pivoting into the south of the border. People going in, especially in 10 years ago, 8 years ago, when there's 2008 bubble, and there's a properties in Florida, of course, compared to the snow, they want to be, buying the properties in South.
States,
so, talking about that, and what are the myths and what are the taboos? What are the, in terms of naked money ideas? What are the things that people need to be knowing about buying properties in the US in a kind of nutshell, because we don't want to give the detail.
For sure. So the US market, tends to be very different from the Canadian market, depending on the areas and the cities and all that stuff. So everybody should do their own research when picking a market to invest in, right? One of the
right timing as well.
Right? Always, exactly.
Absolutely.
It's a
especially
completely
coming
different
in the
economy
election
out there too. Exactly, right? So the one thing I would say is a big myth that I get from a lot of my clients when they're hesitant to invest in the US is they're like, I don't want to pay all these extra taxes, and I'm going to be paying tax twice and all kinds of things like that, which put them off from investing in the US. So actually, the Canada and the US have a tax treaty which is meant to alleviate double taxation. So for example, let's say you go and buy a rental property in Florida and you're renting that property out, right? That's going to be considered US source income, right? So you're going to have to file a US tax return there and pay your taxes to the IRS. Now, on the Canadian side, you're also taxed on worldwide income if you're a Canadian, right? So you're going to have to also include those amounts on your tax return. Now, due to that treaty, Canada allows you to claim a foreign tax credit, which alleviates the double taxation. So for example, like say I was to report my income to the IRS and I paid the equivalent of $8,000 Canadian in taxes to the IRS. And now if I had earned that money in Canada, I would have had to pay $10,000 Canadian in tax, right? So when I put it on my tax return and I claim the foreign tax credit, it'll show, okay, I owe $10,000 in Canadian taxes, but I paid $8,000 to the IRS. So using the foreign tax credit now, I have to just pay the remaining amount, which would be $2,000. So ultimately, long story short, the way the treaty works is you end up paying the taxes to the higher of the two countries, and in our case, Canada is the higher income tax country,
unfortunately.
Right? Yeah. But your ultimate situation ends up as if you had earned that money all in Canada, anyways.
Yeah. So finishing off the 3-tier strategy on the real estate investment.
Yeah.
So when we work with the medical professionals and other professionals who's having active business income, actively doing businesses, but they actually start buying properties or investment properties for their own business or for their rental purposes. They buy sometimes in their own operating company. So we talked about in the past, how we actually advise them. So can you give a little highlights on that?
Yeah, of course. So I always recommend, if you have an active business, which is an operating business in nature, and you're going to be purchasing real estate, whether it's going to be for the purposes of the business occupying it, or, continuously buying real estate and just growing the investment portfolio in the name of the business, always set up a separate real estate company and have that one hold all of the properties. Because you don't want to be mingling your assets with that specific corporation. And the other thing is there's so many additional risks that come with it. So for example, if you're a medical practice and you were to get sued, that person can now go after not only your business but that asset that is in the business, versus if that asset was held in another corporation and it's that business being sued, they can't. So that liability is limited only to that business, right? Additionally, let's say you're a doctor and you have a practice and now you're bringing on a partner and they're buying shares into the company. You now have an asset in that company which you purchased and have owned for this year. That person's going to now have ownership in that asset as well, right? Whereas if you set up a separate corporation and leased it over to your business, now you maintain full control of that asset and all future assets that you were to purchase and have in that corporation, and essentially use it as a real estate company. Does that make sense?
It makes sense. And I think the whole communications, whole concept that we talked about today is a little bit technical, some of the areas. They can feel free to reach us and we can actually help you set up a free consultation. And at the same time, we just chat offline on the good accountant and good financial planner.
So I always tell people this: a good financial planner and a good accountant are very cheap. A bad accountant and a bad financial planner or advisor, they're expensive. So, what I mean by that is you have a good accountant or a good planner, they're going to be saving you so much money that they pay for themselves and it's cheap. Whereas the bad ones are going to cost you.
So net investments return, right? I think it's very well done. Thank you again for coming in the snowy day and slippery roads. But actually our viewers get some insights about things. Thank you for coming in and doing that. We plan to have a couple of more down the road about the same topic in a little bit more details about even talking to the clients itself.
Yeah,
so
100%. Thanks for having me, and I was happy to give value to the audience.
Thank you. Thanks for watching Naked Money, a truth about money in a simple terms. We look forward to talking to you in next week. Please subscribe to our social media channels, YouTube, and continue to watch us and support us. Thank you. Have a good day. Bye.